The biggest one-day event in market history hits tomorrow. I'll show you what it is and why it could be the catalyst that sends stocks into a massive correction. Plus, we have an entire industry on the verge of collapse, and this is after all government attempts to prop it up have failed. And is President Trump right when he says too late, Powell? We'll take a look at the latest FOMC decision and what the data says about the economy and the path of the Fed. Now, let's head over to Goldman, where we picked today's story up, as June brings the largest options expiration in history, and this could be a market-moving event because tomorrow, on Friday, we have $5.9 trillion, that's right, with a T of notational options exposure that expires, which includes $4 trillion of S&P 500 options and $925 billion of notational stock single options. And the problem we're facing right now as we go into Friday is futures are down on what's going on in the Middle East. And let's take a look at this next chart because you can see where the line in the sand is at. It's very clearly at spot at 59.83, but right now futures are below that. And what this is setting up is a potential correction all the way down to 5,700 because you can see that is the next point where markets are hedged at. Again, this is a major red flag facing markets tomorrow. And according to Spot Gamma, they warned that post-OPEX, there could be some equity contraction. They say 5,900 is a target, but based on what we're seeing in the futures market right now, we could blow right past that as all of these options expire. And again, there's a major issue because we look at the markets right now. What do we find? S&P 500 and NASDAQ 100 futures tumbled 0.8% on a day when cash trading in U.S. stocks and treasuries were closed for public holiday. So again, we have hedgers at a value higher than the current market is, and this is setting up for a much larger move in the markets. Could be as low as 5,700. Again, this is an opportunity as we go into Friday. If you're concerned about your positions, you want to put on some stop losses, perhaps put on some hedges, review your positions, because if this starts to slide out of control, watch out below. But something that could be headed higher, that is your trading account. Imagine if you got it on the energy trade ahead of with the conflict in the Middle East. Our Momentum Timer Pro subscribers did. Back on June 10th, we told them to buy XLE. That's up 4.29% and looking to go higher. And we have a major announcement for our subscribers. We posted that here yesterday. There's a link in the description below. Stay tuned to the end of the show because this is going to absolutely blow you away. Because now we're facing the outright collapse of an entire industry as we now turn to China. And what we find out is 6 major cities run out of car buying subsidies. The problem is everybody's been wondering how China's economy has been holding strong. Now we're finding out some of the truth. The government has been propping it up. Now without stimulus, what they're facing is outright collapse. According to Reuters, at least 6 cities and municipalities across China have suspended trade-in subsidies for car buyers in June, which could grind to a halt most, if not all, new car sales in the world's second biggest economy. So again, we're finding out very clearly that China's been propping up its economy, but there's a real issue here. If new car sales grind to a halt, and we've been talking about this in the U.S. economy, as we see demand at the retail level go down, it backfeeds all the way up into manufacturing and across the supply chain, and what that leads to is a lot of hours getting cut, and it's the best case for a lot of workers. It means for China, there could be a lot of people on the unemployment line, unless, of course, Beijing steps in with more stimulus, and that is going to be the likely outcome. The question is, how long can they continue to do it? Because China's government has leaned on subsidies for big-ticket items, including cars, home appliances, and some electronics to get people spending as consumer sentiment in the country remains sluggish. And it's likely that we're going to see other governments try to do the same thing. But something I've been worrying about for months, and that is the problem with all this deficit spending around the world, because the issue is when economies slow down, governments should deficit spend to help boost the economy. The problem is they've been running such large deficits and running up their debt so much they don't have the runway to step in and bail out the economy. Now China does, but at least for a short term. The question is what happens when it runs out? Well, we already know, and that means China's economy is going to plunge right into a recession. Chinese retail sales data for May released earlier this week surprised on the upside, but economists quickly realized that subsidies were the main reason for the higher than expected 6.4% growth. So China continues to buy its way through this trade war. Again, the question is, how long can they sustain this? And if they pull the plug, if they don't continue these subsidies, we already know what happens, and that means China's economy, again, right face down into an economic recession. And what this is doing is unleashing catastrophic price cuts across the sector, which will lead to collapsing margins and failed companies. And we talk about this issue going into recessions. Everybody right now thinks due to the trade war, inflation is going to go up. And yes, prices can go up in the short term, but look what's happening in China. Demand is so weak that what they're seeing is manufacturers slashing prices, they're seeing dealers slashing prices, and yet they're still struggling to move inventory. And this is a major issue, because when we talk about a slowing economy, you want to understand why governments are so eager and so desperate to have inflation. It's very simple. What you're seeing in China right now is the fact that companies could go out of business. That is a simple reason, is there isn't enough money in the real economy when you see things slow down. Let's take a look at the U.S. Consumer Price Index in blue against the delinquency rate in red, because what you find out again in China is businesses run out of money, consumers run out of money, and next thing you know, everything comes plunging down. And that's why you see the delinquency rate go up during times of disinflation or outright deflation, as we can clearly see here going back to the dot-com bubble. We see it happen during the financial crisis, and the risk is, as we continue to see consumer prices all around the world go down and demand go with it, it means we're going to see delinquencies, we're going to see business failures. Now, if you want to understand why governments want inflation no matter what, you hear the Fed has a 2% target. The government will always want inflation. Now, we know consumers don't want that, but governments do. And there's a very clear reason why, because the moment you get rid of demand, well, your economy goes right with it, and that means your labor market. Let's take a look at this chart of the Consumer Price Index now overlaid against continued unemployment claims in red. And what do we see? Periods where demand goes down, you find out demand for labor goes right along with it. You see it happens again in 2006. You see it happens during the financial crisis. It happens going into the pandemic, and it's happening now. And yet at this point in time, what do we hear from central planners all over the world? They want inflation to come down. They're worried about the effects of the tariffs. And yet what they don't realize is it's going to have an impact on the labor market. You see that happen in China. They've got to subsidize several industries to keep them afloat. Again, this is a major problem. But the real issue now, is the Fed too late? Is President Trump right about this? Well, let's take a look at the Fed's latest decision, because according to Powell, well, the rate path is unclear, but tariff impact is coming. Well, I disagree with that. I think the rate path here is extremely clear. I'm going to make the case of what I think the Fed should be doing. I want to know from you. We've been putting some polls up in the community tab. Take a look at that and weigh in. Because ultimately, the cost of the tariff has to be paid, and that's absolutely true. Someone's got to pay it, and some of it will fall on the end consumer, Powell said. We know that's coming, and we want to see a little bit of that before we make judgments prematurely. So right now, what you're seeing from the Fed is they're very focused on their inflation mandate. Now remember, they have a dual mandate, the other side being the labor market, but right now they believe the labor market is strong enough to absorb this, and they want to see price pressure abate. Now what he's telling you very clearly, he wants demand go down. And what are you seeing in other parts of the world? Demand going down. What are we seeing here at home? Demand going down. And what does it bring with it? That's right, the demand for labor. The issue here is, of course, we know U.S. consumers can't afford higher prices, and we start to look at the data and it gets very clear. Now let's overlay the Consumer Price Index with average weekly hours of production of non-supervisory employees in red. We could see periods from A98 all the way into the dot-com bubble, where inflation went up, but weekly hours were on the decline. Workers couldn't afford higher prices, and sure enough, that meant inflation turned into disinflation. We see the same thing happen going into the financial crisis, except instead of disinflation, we got outright deflation. So the notion here that the Fed is confused about rate path, well, it makes absolutely making no sense, because when we start to look at the details of what they think's happening, well, they think stagflation is coming, and that means higher unemployment, higher prices. Now, in that case, what do? Well, you should be cutting rates to try to stimulate the economy, because the moment you put people on the unemployment line, their spending goes down. And then, of course, we know that the economy goes right into recession. And here you can see, based on their projections, they think the unemployment rate gets up to 4.5% and peaks. They think the PCE inflation gets up to 3% and peaks. And they think core PCE gets up to 3.1 and peaks. But here's the thing. If the unemployment rate continues to go up, and I think it's going to get a lot worse than 4.5%, inflation isn't going to be the problem here. So in this case, I agree completely with President Trump. I think the Fed is too late. But here's the problem. The Fed's always too late. It's not just Powell. It's every Fed president throughout history. Several officials, including Powell, have highlighted the central bank's commitment. That's right. Several officials, including Powell, have highlighted the central bank's commitment to ensuring price pressures don't become more persistent, which means they deliberately want to slow down the economy. And I want you to see very clearly that these central bankers want to push the economy into a recession because they don't understand that tariffs are a tax. That means they can't be passed on to workers in terms of higher wages. And if wage growth relative to inflation continues to cool off, we're not going to see persistent inflation because people cannot afford higher prices. And yet we're going to see this in the automobile industry, as car buyers will bear the brunt of the $30 billion cost of President Donald Trump's tariffs, driving up already high U.S. auto prices by an estimated $2,000 per vehicle. This from Alex Partners. And so we look to Ford and General Motors. They said they expect a $5 billion and $2.5 billion tariff impact this year, though they said they would find offsets in part through price adjustments. And this is critical to understand. The Fed says, look, prices are going to go up. What are we hearing from companies like Walmart and Target and Amazon and now even the automobile manufacturers? They know very clearly consumers can't afford them. They cannot afford any tariffs or higher prices. They're doing everything they can to absorb them. Of course, this is going to have an impact on the stock market at some point, whether it's going to be this coming quarter when we see earnings or the following quarters when it finally eventually shows up. But the reality here is we're not likely to see persistent inflation at all, which is why we see these central bankers continue to be on the wrong side. And again, I think President Trump's got this one right. It's my opinion. How about yours? Is Powell too late? Weigh in the comments below. The minutes showed an expected significant slowing over the rest of the year in pay growth amid further loosening of conditions. So they think financial conditions are getting easier, and yet workers are going to see less pay growth. That's because, again, these central bankers don't get it. Powell wants to bring inflation down. Well, what does that mean for the average hourly earnings of a reduction in a non-supervisory employee? It means pay growth is going to decelerate. You can see it very clearly throughout the cycles here as the consumer price index in blue goes down. With a lag, average hourly earnings follow each and every time. Right now, central bankers want to constrict demand. They want to bring inflation down. They're going to bring not only hourly earnings down, they're going to bring weekly hours worked down, and on top of that, they're going to put people on the unemployment line. They're going to get rid of inflation, but it's going to come at a cost of a recession. And yet that's why we're seeing investors still holding U.S. Treasuries despite rumors that people were dumping them. Financial holdings totaled $9.01 trillion for the month, the second highest figure on record, and down just $36 billion from March. The drop mainly reflected net sales by foreign private investors of U.S. notes and bonds. Meanwhile, official entities were net buyers of long-term Treasuries. Why are we seeing people hold on to the long bond? Well, it's very simple. Rates are a function of growth and inflation expectations. Right now around the world, it's very clear we're seeing growth come down. And when growth goes down, particularly if it's led by a rise in unemployment, inflation is going to come tumbling down. And that means rates go down, bond prices go up with it. And that's why we're seeing there's a big difference between the valuation of the reserve status of the U.S. dollar or U.S. Treasuries as the de facto safe asset. Right now, people don't want to hold dollars, but they're very clear. They absolutely do want to hold long-term bonds. And that is simply for one reason, the price appreciation when interest rates come down. And we know it's only a matter of time before the Fed catches up with reality and starts slashing rates. We could see it being led by potential correction in the markets, followed by entire industries like in China failing. And next thing you know, as U.S. workers hit the unemployment line, central bankers around the world will be slashing all the way back to zero. But there's a way to take advantage of the markets in these conditions. Let's talk about this major update. I'm going to put this link in the description below because right now we are working on an impressive trading system. We're taking everything to the next level using advanced AI technology. We're building a brand new program right now that's going to integrate and optimize every major swing trading strategy available. That's right. It's going to put all of them in there. It's going to dynamically optimize, sort, and rank these signals, including back testing them, and provide high potential opportunities. Now, right now, we're working on this for both of our reports. Our CTA report's a lot harder to do because it's very complex, but as we start getting signals generated, we're going to put it out to all of our subscribers for free. That's right. If you want to get in on this, you need to be a subscriber. Now, let's talk about that trade on the energy sector. How did we do it? Well, we call that our Momentum Timer Pro report, and each and every day we look at the technical indicators like the RSI and the MACD, and we wait for them to get into oversold territory. But when they come out of that, if it's not matched by a rising trend, we hold off. But if we get a rising trend and a rise out of an oversold condition, well, that shows right up on our hot list each and every day. But you get the momentum indicators on a 1 day, 1 month, 3 month, and 6 month window to help you gauge where the markets are going across a broad equity, bond, currency, and commodity markets. Now, you get the daily reports, you get the tradable signals, you get my opinion on the best trade, you get risk control levels, and yes, we update them to our subscribers along the way. You get a full tracking of all trades and returns, a weekly update, and not only do you get a free 30-day trial as we roll out these signals, we're going to be providing them to all of our subscribers, again, at no additional cost. For right now, grab that 30-day trial, use the links in the description below, use the coupon code for your free 30-day trial. Well, that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.